in the face of high inflation and peak interest rates, Bidvest has reported pleasing interim results. The trading and distribution company posted a 5.3% growth in headline earnings per share, as 5 out of its 7 divisions delivered double-digit growth. Joining me now is Bidvest CEO Mpumi Madisa. Mpumi, thanks so much for joining us today. Now, overall HEPS growth has slowed, Mpumi, and any kind of growth is actually welcome, especially in this challenging economic environment. Just put into perspective for us the 6 months that was.
Thank you very much for the opportunity. Yeah, you're right. It was a tough 6 months. So let me just start by saying that the operating environment is tight. And I think you alluded to it. You know, we're in a high inflation environment. We're in an environment where wage inflation is exceeding CPI. We've got high interest rates. It's a highly competitive space. But I would probably say that our results are made up of 4 key drivers. So the first being strong new business wins, both in South Africa and in our offshore operations. And I think the teams have really done well. I mean, it's not like there's massive economic growth, and it's really just us being highly competitive in the market and being able to take away contracts and market share from the competition. So new business wins have been very strong. Secondly, margin management has been very strong. And I mean, in a highly competitive environment, the one thing that takes a knock quite significantly is your gross margin. And you've seen our gross margin is down 0.6%. But I think the teams generally have really done well to hold that margin either in line with last year or slightly up. The 2 areas that are under pressure from a margin perspective have been the automotive division, and I'm happy to go into that. And we've also seen a margin reduction on the renewable side. Then the third area, expense management, has been outstanding. Our expenses increased 3.6%. That's significantly below inflation. And if you exclude acquisitions, expenses are only up 1.9%. So the expense control has been solid, and we haven't had retrenchments or anything like that. It's just been really good cost discipline. And lastly, we've executed on our M&A pipeline. We concluded 9 transactions in the period. Hygiene businesses offshore. We doubled our footprint in Australia from a facilities management perspective, and we also did bolt-on acquisitions in South Africa. So that's also been really good for us.
So operational efficiencies really coming through and showing that the company is basically strong. It's just this challenging economic environment. I want us to zoom into those segments. Now, 5 out of 7 divisions posted double-digit growth. 1 delivered somewhat tepid growth, and the laggard was the automotive sector, as you did mention up at the top. The only division where we saw losses in Mpumi. Trading profit down just over 11%. Talk us through the kind of pressure you're feeling on that front.
Yeah, so trading profit down 11%, and really we're in a down cycle, if I could call it that, overall in the market. There's a significant amount of inventory supply in the system. We are seeing a definite drop in volume, and we're seeing this both on new and used vehicle, on the new used vehicle side. I spoke to the gross margin. We are seeing a significant amount of discounting, and the gross margin is down on both new vehicles and used vehicles. So really a very highly competitive trading environment. And I guess one of the things that is happening in this environment is that the traditional OEMs, and that's really who we mainly represent, have lost quite a bit of market share in the first half of the year. And you're seeing newer brands coming in, and they've increased their market share. So obviously, in order to mitigate this, we have had conversations with some of the newer brands that we don't represent, where market shares are growing. And when I did the presentation, I did indicate that we have been awarded 4 dealer points for Mahindra. So we now represent Mahindra for the first time. And we've also been awarded a dealer point for FAW, which is a truck brand. So we're now getting into those brands that are growing. And then lastly, on automotive, we are looking at a diversification strategy so that we can kind of reduce the cyclicality of the automotive industry. So we do have, from an M&A perspective, some bolt-on acquisitions that we're looking at that are auto-related services, less cyclical. And so I'm hoping that we'll be able to announce those by the time we get to year end.
So the laggard aside, we had financial services continuing to deliver upbeat results. I know the group has implemented a turnaround strategy at Bidvest Bank that's been bearing fruit. Would you say that everything that needs to be implemented is there and that that division is ripe for even further growth? Or are we just seeing the uptick on the back of those higher interest rates?
So I think you're right. If you look at the top line of financial services, they're flat. So there isn't significant growth coming through on the top line. It is mainly interest rate driven. And the second part of what's driving the bottom line is expense control. So the cost to income ratio in the bank has improved significantly, and the expense control across the division has been strong. And so you're right. Look, the team is delivering on the turnaround. We're pleased with the improvement that we're seeing, but we are still seeing an underperformance in the bank from a fleet perspective. Fleet is a big opportunity for us. It is the niche where we want to really make sure that we deliver results and we build a significant market share, and unfortunately, fleet continues to underperform. So there's still a lot of work that needs to be done in the bank broadly.
And there's one more division I want us to actually touch on, and that's the freight business. Mpumi, how does the logistics challenges at Transnet filter through to that unit? Does it have a negative impact? Does it have a positive impact?
Yeah, I mean, so if there's no rail, that's a negative impact. And in fact, I mean, we've just seen a significant reduction in rail to our terminals over the years. And in fact, in one of our bulk mineral terminals in this financial year or in the half year, we didn't receive any cargo at all on rail. It all came on road. So it does have a negative impact. Our teams, when it's difficult, they find a way. And so we've managed to work around the inefficiencies. But one of the things that wasn't great in the first half of the year, which is new, is just an inefficiency from a marine services perspective. You will recall that there were a couple of ships that were stuck at the port and weren't being brought in time. And there was a big delay. So when there's a delay, it means we're not handling product. When there's a big delay, it means that there's stock that's sitting on ships that should be in our retail branches, in our trading businesses. And so those inefficiencies that you're seeing from Transnet definitely have a negative impact on the results. But notwithstanding that, the freight division performed exceptionally well. And I mean, they've increased profitability by 16%. That's an amazing result.
Mpumi, unfortunately, we have to leave it there. Thank you so much for joining us and just sharing insights on the 6 months that was for Bidvest. That was Mpumi Madisa, CEO of Bidvest.